Good morning, ladies and gentlemen. Well, the risk dial is back towards the highs around 66. What I find interesting is that even with this quite enormous breadth thrust that we've had over the past couple of weeks, we're not really going back into the 80s and 90s, which is where the risk dial is normally when we have a strong trend. But it did its job. It stopped us from turning bearish too soon. And normally when this kind of a breadth thrust takes place, it lasts quite a long time. So I think we're unlikely to be in risk off for many months to come. If we now turn to the spread ratios aggregate, we can see that the volatility attribution stacked is still quite high. It is entirely possible that we spend several weeks at these kinds of levels and therefore bring down the overall volatilities to something this kind of a median. That would be perfectly normal, and the model actually indicates that that is the likeliest outcome. While technology has such a low volatility, it is terribly unlikely that we get a risk-off impulse anytime soon. So stability is what the model indicates, and at higher levels of price. So that is what I am looking for the next few weeks. Really a range trade where you have to be much more precise about your entries and exits, and really not a trend. I don't think that the model indicates that a trend at the moment is possible, and I'll look at what the bonds are saying now and why they are agreeing that we are in possibly a wide trading range, but a trading range nonetheless. Before we have a look at the bonds, let's have a look at term premium, and let's have a look at also real rates. Now, what happened over the past few months? First of all, you had a shock whereby the market had to cope with a lot more issuance than it was expecting in terms of duration, and term premia went out. As soon as term premia on the bonds went out, the stock market had a bit of a fright and it went down. And then on November the 1st, Janet said, okay, let's switch back to bills. Let's issue far more bills and give duration a bit of a rest. And term premia came down approximately, 20-25 basis points. And this 20-25 basis points is actually something that we'll echo and we'll see in other charts. Well, how likely is it that term premia go to zero or negative again when we have 350 billion worth of issuance of coupons in the next quarter? I think it's terribly unlikely that we go below zero, and that means that we will be stuck somewhere between slightly positive term premium and not go above what we saw, which was around the 40-50 basis points at the highs. So that will be a reasonable range for us to be in. If we have a look now at the real rates, well, we got to somewhere around 255 when I got in, and we are now, sort of bumping around the 215 area. I think, again, it's very unlikely that we go below 2. So we have our range. Our range is somewhere between 2 and just short of the highs around 250. So a 50 basis point trading range for real rates. Given the fact that inflation expectations are roughly stable around the 2.25 area, and will keep on going up and down around the 2.25 area. And let's have a look. We started the year around 220, and we will finish the year around 220. So inflation expectations are remaining stable, and it's just a question of finding the range at which the term premium and the real interest rates feel comfortable. And I think we found it. We found the 50 basis point range where we will oscillate up and down. And let's try to apply that to the bond ranges. Now, this is the 2-year note. Terribly, terribly unlikely that we break 475 on the 2-year. As I've been saying for a long time, I think the 2-year is now stuck between 475 and 5. A 25 basis point range at the short end, which is going to expand as we go down the yield curve. If we look at 5s, I think the 5s are going to be the most volatile of the individual tenures, simply because people will be going in and out of the belly of the curve. For 5s, I think anything around 427 is where you definitely don't want to own them anymore. And if you see them up here around 460, you want to bet the farm that they're going to go back down. I think we have seen the highs for the time being. I say for the time being because I have no idea what real data is going to be, come January or February. Could we have a re-acceleration of the economy? It's entirely possible. But as I told you last time, we're more data dependent than ever, although at levels we are no longer data dependent. It would have to be a ridiculous weakness in the economy for 5s to go through 427. You'd have to have an acceleration of unemployment, a unexpectedly large deceleration in inflation, something which would argue that the Fed needs to cut. And then the volatility would actually shift back to 2s rather than 5s. So really anything around 427 in 5s is not a good risk reward. In fact, it's a very poor risk reward. To me, the range in 5s now is 427 to 460. That is your range. And as we go down the yield curve, you will see that the relationship between 10s and 30s, and actually we can have a look at that now, that's 10s, 30s. What does this tell you? This tells you that you are completely indifferent whether you are now trading 10s or 30s. The relationship between them is 5 basis points one way, 5 basis points the other way. 10s and 30s are now joined at the hip, which means that you really don't care whether you're trading 10s and 30s, it's the same thing. So let's have a look at the 10s. To me, 428 in 10s is as far as it goes, and then something back around here, 472, 475 at worst, is where I see that range. And that's a 50 basis point range that we're going to get, and where term premium go towards 0, and where term premium go towards their maximums and do not exceed their maximums. To me, we are now in a 50 basis point range at the long end, and what you are actually trading is this. You are now actually trading the butterfly 2s, 5s, 10s. That is what you are now trading, and if you see the butterfly at 54, you're out of it. And if you see the butterfly at these levels around 28, you're in it. That is what I can foresee until the end of the year, that we are in a 30 basis point trading range for the butterfly, and that we are in a 50 basis point overall trading range for 10s and 30s, because they are the same thing. What does that tell you? Now, this is now move. It tells you that move is stuck between 98 and say 130. And the next big move in rates is going to be when we bust through this 90 to 97 area in the move index. And then we will have a big move all the way down into the 40s in the move, and a collapse in yields. But it's a long way away. I just can't see that happening until Q1, late Q1, early Q2 of 2024. And in the meantime, we are in that trading range, and all we're trading is the butterfly and the spreads to other markets. Let's have a look at Germany, where I think things are slightly different than in the US. This is now the Schatz, the 2-year. I think this has an opportunity to trade lower down to 268, but it's not a huge opportunity. We keep on being in a tight range of basically 292 to 320. 25 basis point range, much like the 2-year note, but I think this one is in far more danger of busting down towards the 267. And we'll have a look later at the relationship between twos. The 5s are absolutely critical. Have a look at how well this line here at just over 245 keeps on catching these lows. I think a weekly close below there really takes you down to 211, 212 with 30 basis point move. So you can see the difference between the 5s in Germany and the 5s in the US. And this makes sense if the market starts anticipating an easing from the ECB, but not an imminent easing. So what I'm trying to say is this: if you think there will be an easing towards the latter part of next year, buying 2s at these levels where they're already discounting that easing is not as good an idea as buying 5s at these levels, because the belly of the curve will definitely go more on the anticipation of the easing. The reality of the easing will then move 2s, because once the ECB starts moving, then it means that there's something going on and they need to cut. And they're not going to need to cut once, but then they're probably going to need to cut 2, 3, 4 times in a row. And that's when the 2s start going. But in the meantime, it's the belly that will go. So this is the level that I'm looking at, like a hawk, this 245. And 10s and 30s in Germany are more or less in the same position as the 10s and 30s in the US. They're equivalent. Their spread is really not going very far. Let's have a look at the spread. 10s, 30s are basically now in a very tight 10 basis point range, and we are going to learn nothing from them. So Bunds and Buxel, they're the same thing, so you might as well trade the liquidity, and that's the Bund. So the Bund keeps on failing at this level, which is around 258, 259. I think sooner rather than later, if we see these levels around 270 or 267, it's more likely to bust it to the downside and go down towards this 240 level. I don't see it through there anytime soon, but I think risk reward says from 267 to 270, you buy call spreads on the futures looking for this kind of level. And if we really look at the differential between 10s in Germany and 10s in Italy, this is the kind of level where the risk reward says you've got to start looking at Germany. We played it very well, got out of the highs. I'm feeling like getting back in around this 171, 172. I think the risk reward is enormous. And really, the risk reward is enormous because of this butterfly, which is the Germany in the middle and US and Italy on the outside. So let's give this butterfly a narrative. What happened here was that we started anticipating that the high issuers, i.e. the US and Italy, would need to issue a lot more. Then in August we had the QRA and the butterfly started collapsing. And it started waiting for the next QRA and how much issuance we were going to get back here. And as soon as Janet said, not as much issuance, boys, we started going back up. But we still have the issuance to digest. I think that if we see these levels, 350, you are looking to position bunds against tens in the US and the BTP. This is the kind of level that I think is ideal, just short of this minus 340, where you're looking to position bunds and go long bunds against both of these. Makes perfect sense to me, and I'm waiting for both this down here and this up here to position long bunds. Let's have a look at the individual spreads between the US and Germany, and you will notice how different they are. This is 2s, and you can see that 2s are absolutely stable, within a 10 basis point range up and down, but they're essentially stable. They're going nowhere. And then we start going towards the 5s, and you can see that that is actually coming down. I think if we see 5s anywhere near here, 180, I think they are a monstrous buy. I think we will return towards this 230 area at some stage. It just makes far more sense to me that the belly of the German curve will get bought more than the belly of the US curve. I think the situation in the EU is, in terms of the economy, is far weaker than the one in the US, whereby there's a reacceleration risk of everything, inflation, economic activity, etc. In the US, I think those odds are far lower in the EU, and I think the belly against each other at these levels just becomes too cheap, and that is what I'm also looking at. And if I look at tens, I think we start putting on the position around 178 and the last bit at 172, because I think that also goes back up towards 195 to 203 at some stage. But 5s actually looks the most interesting. Around these levels, I think 5s is a great risk reward. So that is what I'll be looking for next week and the next few days. If we see it down here, I think the risk reward is massive. And let's have a look at 30s, and let's put a narrative to it, because that's always interesting. Now, let's have a look at this day here, which is August the 2nd. This is the day that they announced massive new supply in the US. Okay, so 30s breaks out from this level and goes up. This is the day that they announced less supply, or less than the market feared supply, and we start going down. Now, still supply, right? So what are the odds that we go in 30s lower than something like here, 165, i.e. 15 basis points away from where we are? I think the odds are almost zero, because the supply is still the supply. So if we see 30s around the 165 to 170 area, this kind of area, risk reward says massively to the upside. Buy Buxel, sell bonds. Now, are we going to see this? I don't know, but I'm just giving you a narrative why the market should not go through these levels. If we see them, the risk reward is excellent. And if that is the risk reward in the 30s, we can do the same kind of narrative here. This is where we broke out August the 1st, and we started going up. Okay, we come back to this kind of level, right? But no more. So really 172, 173 here is massive risk reward that we don't go through it, but bounce and return towards 195. Let's triangulate what I said in the spreads of the interest rates with what is happening in the dollar. Very proud of this call up here, saying the risk reward was awful up here in being long. And I think the risk reward in being short around the 102.80 area is, or just below, because let's face it, on the dailies we have this 101.92 support. So, sorry, on the weeklies, so it could come all the way down to 101.92, i.e. just below 102. But we have, basically it's a percent, right? So this kind of area. I think the risk reward of being short dollars there is going to be absolutely awful. And that is what tells me that we are possibly likely to see those levels in 10s, and 30s that I was just talking about, i.e., another 10, 12, 13 basis points lower in those spreads, which gets the Dixie down to these levels where the risk reward of being short dollars is very, very poor. But while the dollar is in this kind of a downtrend, and I think we will see these levels, I'm hoping we see these levels, because they will both provide a very good risk reward to go long dollars and long of the spreads in Germany against the US. This gives you a wonderful risk reward for everything, and basically tells you that the risk on that we're having, because we always have risk on when the dollar is weak, because it supports emerging market currencies, it supports investment in emerging market equities, and it increases the dollar earnings of the S&P 500 companies, which have significant overseas earnings. So while the dollar is doing what it's doing, and I think it goes down here, as I've just told you, it's risk on. It's the odds of equities anywhere and everywhere going down while the dollar is doing this is very much decreased. And it's not until that we are here in Dixie that I will even start thinking about selling equities. Now, what does that mean in terms of the Euro USD? Well, it really means this 106.40 level. Likely to see it, likely to fail. Risk reward up here, I think, is going to be extremely poor, especially as we have on the weeklies. This is just about where the 200 week moving average comes in at 111.30. So what's that, half a percentage point away from this level? Nothing to worry about. I think the risk reward up here is to be short of euros and long of dollars. But while this takes place, and I think it might be a few weeks yet, you are definitely in risk on in terms of equities. The pet rock, well, I don't really know what to say about the pet rock, because if I'm not bearish bonds. And I think that real interest rates probably have another 10, 20 basis points to go down. And if I'm not bearish on the currencies, in fact, I'm bearish on the dollar index for another couple of percent, or whatever it might be, I think it's terribly unlikely that gold collapses. And in fact, gold has been doing nothing for the past 3 weeks. It's been going up and down in this range, basically just getting people bearish, going through 1959, but really doing nothing. It's very, very unlikely that we are going to do very much on the downside in gold. I think any kind of a move towards 1958 is more likely to result in a bounce towards this 2015-17 area, where I think it's a sell again. I think it's now a range, and I don't think that we're likely to bust the range, simply because I don't think that real interest rates are going to go below 2% in the US. And I don't think the dollar is going to collapse, but it's going to stop at that 102.80 to 101.90 area, which says, yes, gold can, break up slightly higher than, 2020, maybe go up to 2040 and then come back down. So we're in a range. I really would not get excited about gold. Really nothing to say apart from sell it up here. And, if it starts going back down towards 1940, odds are that it bounces. Oil is getting interesting. And I think any touch of this 200-week moving average, which is now at just below 70, but let's call it 70, is going to be very, very interesting for call spreads. I really don't think that we can break these levels, because A, the US wants to replenish the strategic reserve, and B, I think that they struck some kind of a political deal with the Saudis, keep the oil price here, don't let it fly. But I think that these are levels where the Saudis are going to say the other way around. They're going to say, okay, we kept it stable, but you keep it stable to the downside. And they're going to, it's going to go back into the 80s from, almost for sure. This 83 level, I think, will be seen again. So anything between, 72, 73 and down to 70, I think is a cool spread area for a trade back up into the low 80s between 83 and 85. I really think that this is stability again in the oil market. I think that they've had political shenanigans here not to let the oil price go up during this conflict. And now that that's been achieved, the political shenanigans will happen to the downside if it's too weak, and they'll bring it back up towards the 80 to middle 80s. And that is the only thing that really makes sense to me, because if oil now starts breaking decisively through 70 and through 65, then you're looking at bonds screaming higher, because they're all going to be saying, oh, inflation is dead. And then my narrative really starts falling apart, because if I don't see the US bonds doing much better than other 15, 20 basis points, then it starts going into some kind of a risk off, doesn't it? Because the only thing that will start making sense is that the relationship between inflation and real rates is breaking, that the relationship between bonds and equities will be breaking, because why should oil start going down massively from these levels? Well, it must be a demand shock, right, rather than a supply shock. So there's much less demand for oil because production isn't going up, so it must be demand. And if it's a demand shock, then it has to be an economic collapse somewhere. So the whole thing starts breaking down. Everything that I've told you starts breaking down if oil starts breaking down through these levels, because nothing makes sense anymore. There has to be some kind of economic weakness for that to happen, and really we're not getting that data. DBC also is not giving me that idea that the impulsion is to the downside. I don't think that we're going to get impulsion. I think we're going to get just a continuation of a trading range. And really, these kind of levels around 23.30 are of interest to me to add to some DBC positions. Really, I think we're going to be stuck in DBC. And where did we start the year in DBC? We started the year right here, and basically we are where we started the year. No inflation in commodities, and that really basically gives you the idea of the stability of the inflation picture, and therefore that bonds aren't going to go a million miles one way or another. It's only if it starts accelerating up that I would start getting worried about bonds. So it tells me the same kind of stability that I've been talking about up to now. Before we start talking about equities and levels, let's have a look at what the Blue Angels are doing. They're slowing down. It's stability. Are we likely to start going much higher than these highs here? Well, it's unlikely because bonds are not going to go that far lower in yield, higher in price, and therefore we are unlikely to get the impetus that we need to start breaking the times 19 Blue Angels. We're already anticipating 25% increase in earnings over 2024 and 2025. And really, it's a question of multiples now, because let's assume the earnings increases are fine. But we all know they're not going to be realized. I mean, there isn't anyone out there who really believes the sell-side analysis that we are going to have 12.5% earning increases in 2024 and 2025 on top. I think, that person doesn't exist. That's just such wishful thinking, especially if the economy, GDP is going to moderate down into the twos or ones, as we're already seeing. So it's terribly unlikely that we start breaking through the times 19 and approach to times 20. Certainly not for a while. Far too much uncertainty. So breaking these highs here and getting everybody long and then coming back into a range is what the market would tend to do. I think these highs here are definitely in danger. But after that, I think we are back to some kind of a range trade. So let's have a look at what that means on the clean chart. And I think what it really means is that we are terribly unlikely to go below this range, which is 43.85 to 44.23. Any kind of a pullback is going to get caught right here. And really we are looking to fill this gap up here. So let's enlarge this for you. Okay, so we have this gap up here, which will be filled. I'm absolutely sure. Whether it's this week or next, 45.72. And once we do that, we'll take out all the stops that are here and probably stop around 46.46 and then come back into the range. Or the other alternative is that we come back down and bounce off this support around 44.30, never close this gap fully, and then go. Either way, I think the likelihood of having risk off or much lower prices over the course of the next few weeks is very low. I don't think people are long enough. I think any pullback is going to be bought, and that we are definitely going to take out these highs, but then come back into the range. And that fits in with my narrative of bonds having a natural floor of the tens around in that 4.25 area, and the twos also being stuck, and therefore that is the maximum that I can see this market doing. And we all know that the S&P wants to absolutely screw everyone, and therefore a move above this level where all the shorts get stopped out and everybody starts getting long and then coming back in is the natural thing for the S&P to do, especially since I really can't see why I should go above that times 19 and a quarter time in the Blue Angels that I just showed you. It's the only thing that makes sense, that we are in a 3-4% range, with the downside, definitely very well anchored at these levels. If it starts going through these levels, something has changed, but I don't see what has changed right now. And we all know that the impulsion in S&Ps comes from only one place, and that is from technology and the Magnificent Seven. This is now a weekly chart of the NASDAQ. And what I want you to look at is really how well it respects the weekly Bollinger Bands. Even during periods where it's going up strongly, it always consolidates. And don't forget, these are weekly. It consolidates and comes back, and it doesn't run away. For the SPX to now start going and making new highs that some people are calling, this NASDAQ chart has to go exponential and trade way above the Bollinger Bands. And throughout these periods, it's really respected the weekly Bollinger Bands very well. It goes up slightly through, like here, and then it spends 4 weeks coming back and trading the ranges. So I would say that the NASDAQ has got this kind of objective over the next 2 or 3 weeks. 16,300, 16,500, and a consolidation of several weeks. That doesn't tell me that the SPX can go much higher. So even if the NASDAQ takes out all the, this previous high and everybody gets stopped out, it's not going to go a million miles, because the weekly Bollingers are going to keep on coming, making it come back. In which case, you're getting the story. It's all a big range trade still. But what is noticeable is that the stock market and the bonds are still tied at the hip. This is SPY TLT, and you can see how long we've been in a very narrow range. And even if we look at the totality ITOT over government, we can see that we are still in the same range as we have been since July the 31st. So really August, when the QRA came out, right, until now. And what is the narrative here? When we started collapsing in the bonds, the stock market went more or less with it, and when we came back, the stock market came back with it. I think it's far more likely that we remain in this range until the end of the year, and then maybe start busting it next year if we have a reason for a reacceleration of the economy and some kind of a confirmation that yes, we are going to get lower inflation and higher growth, i.e., the soft landing that everybody wants. I think then we can start busting it, but it's unlikely that we go very far at the moment, because even if we switch that to something like a weekly, we're there. If we're not going to go a million miles, even if we start busting out now, it might go 3-4%, and that's about it. So I think it's terribly unlikely that the relationship between bonds and the equities starts favoring equities massively, and equities start outperforming massively. And you can see SPY TLT, how far is it going to go? Couple of percent. So if TLT stays in the range that I've described, equities can go another 3-4%, which is the upside that I showed you. And I think that that is going to be the stability that we get over the course of the next couple of weeks. Even Europe is bullish. I think that we will trade this 43.83 level, or 43.66 at a minimum is almost guaranteed. And I think 44.35 is actually where we'll end up for the time being before we stall out. And even the Nikkei, it's just opening up, maybe another couple of weeks of sideways, and then I think we start busting the highs. To me, the Nikkei is the one that has least risk and most reward for the time being. So I really don't see why anybody would want to be massively bared up in equities or thinking that we're going to get any kind of a collapse. I think in Nikkei, if we see anywhere around the 33,000 level, the risk reward is for the upside, which also tells me that the downside in SPX is likely to be limited to what I just showed you in the previous bit. And with that, I've amended all the levels, and I think the things to play are going to be Germany against the US, and I think the butterfly between Germany, US, and BTPs. Those are the things to be really concentrating on. And I think any kind of move down in SPX is a buy, especially around this 44.23 level, which I don't think we will see. But if we see percent off, 2% off in SPX, I think it's safe to buy it. And I also think it's very safe to buy the Nikkei around the 33,000. I think into year end we will have the spike that we wanted in SPX, in Nikkei, that gets it to around 36,000, and that's my target really there. I don't see anything bearish on the horizon. I think more stability in the bond market is going to provide more fuel for equities to go up, but not massively, as I showed you, because there are no reasons for bonds to go up massively, and therefore the relationship between bonds and equities is going to remain roughly stable, but slightly in favor of equities. Thank you very much indeed, and tweet you tomorrow.